fourth straight day. FundStrat's Tom Lee remains optimistic about the market and joins us this afternoon to talk more about the geopolitical tensions we're seeing. Tom, good to see you again.
Great to see you, Carl and Morgan.
You've said in prior times of stress that it's not a good time to be a hero. Is this one of those times?
Well, I mean, it's been a very difficult setup for markets because we were already seeing markets struggle with inflation and Fed hikes and rising rates, and then now we have a real escalation of geopolitical tensions. And that's correct. It's tough to be a hero, but I think investors are on that sort of cliff edge, and I do want to just, encourage people. This is a good risk-reward moment for stocks. I know it's kind of ugly today, and it's been a very ugly few weeks, but I would still sort of lean pretty hard into this and say, this is not a time to be selling stocks. I'd rather be a buyer here, even if there is potentially some downside.
I was going to say, it sounds like your view for the first half in general is somewhat treacherous before you see the markets improving in the back half of the year. If you were to get in around these periods, you'd be in for a few months of where it would demand you to be patient, I guess.
That's right, Carl. I mean, I guess, in December we thought, it would be very difficult to make money in the first 6 months of this year. But now we're in February, the market's down 10%. I mean, I think the one thing that we all have to ask ourselves is, how much more bad news can happen between now and the end of the first half that would push stocks down. And this is where I'm really starting to think that, maybe a lot of that downside that we thought would happen sometime in the first half, down 10%. I mean, we're already pretty much here. So, I know we're in a buyer strike, and I know investors are nervous, and nobody wants to see global conflict and deaths and civilian casualties. But at the same time, we should also just even look at what the market's telling us. I mean, Ukrainian stocks are actually outperforming, and they've outperformed for the past few days, even as Russian stocks are underperforming. So from that perspective, I almost would say a half full glass perspective that it may not be as bad as we think.
So Tom, in terms of that, you're a buyer of what at these levels?
Well, I think there's a lot of things that have become really attractive. We've spent the last couple of weeks, spending intense amounts of time with our clients. A lot of them want to look at a lot of high quality names that have gotten really cheap. And I mean, some things that really come to top of mind are things like FAANG, right? Meta is probably a 15 times forward PE. Microsoft's under 28 times forward earnings. And then if you look at real asset stocks, energy remains one of our top and favorite sectors because the energy stocks are so cheap to oil, and oil at 93 means that, I mean, if you look at OIH, it's discounting $51 oil right now. So you could have a huge re-rate in the energy stocks even from here. And financials, I think, haven't really caught up to what has happened with the curve and with rates. So I think there's still a lot of things to buy. And our acronym is BEEF, Bitcoin, equities, energy, and FAANG. Crypto's obviously had it pretty rough, but it's kind of a risk-off asset when equities are down.
Yeah, which still has a lot of people shaking their heads, Tom, as the inflation hedge story has taken a hit. Even the payment mechanism arguably has a long way to go. This morning, a lot of discussion regarding 30K now, the new place to watch now that we've fallen under 40K. I mean, it wasn't too long ago we were talking about 100K as a target. Is that ever coming back?
Yes. Yeah, I mean, I think what anyone looking at Bitcoin has to remember, they have to widen their bands of what they consider trading ranges. I mean, I know it's a little eye-popping, but what we might say is like, plus or minus 5% on the S&P shouldn't really rattle people. In crypto, it does seem like plus or minus 30 is sort of the more normal range band. And I think that the runway for Bitcoin still remains tremendous. I mean, I think you just have to use longer time frames because, 5 years ago, we wrote our first report on Bitcoin, and we recommended a 1% allocation. If someone just hodled that, even accounting for the S&P rising, it would be 40% of their portfolio today. So I think over the next 5 years, can Bitcoin deliver super normal returns? I would say, given there's only 21 million real users of crypto today out of 7 billion people, there's a lot of runway.
That's some interesting context there. Just out of curiosity, though, You mentioned Ukraine outperforming in recent days. Are there opportunities abroad, or should investors, because there is uncertainty, be sticking closer to home?
We think for people picking stocks, and I think that's most viewers, they want to buy the best companies and then buy them in the most liquid markets. The U.S. dominates technology, financials, and healthcare, and that's 70% of the S&P 500. In fact, these three dominate pretty much the global market cap. So I think when you talk about liquidity and quality, it would take people back to the U.S. And I think, for instance, just the top 5 stocks in the S&P trade more than EMEA combined. So there's a much greater ability to get in and out as well.
Tom Lee, thanks for your take. Always great to speak with you. Straight ahead, stocks falling on tensions between Russia and Ukraine. We're going to wrap up the markets and take a look at the moves in energy. When we take you inside, get ready for it, the Market Zone.